In this video, we'll show you the only 3 semiconductor stocks worth buying now after one of the biggest sell-offs the industry has seen in years. You'll discover why some of the most important companies powering the AI revolution suddenly became cheaper, why Wall Street may be overreacting to recent headlines, and which semiconductor businesses could still have enormous upside despite the volatility. The semiconductor sector entered June with incredible momentum, but that momentum hit a wall almost overnight. After a spring rally pushed valuations to uncomfortable levels, investors were looking for any excuse to take profits. They got one. A disappointing AI revenue guide from one major semiconductor company triggered a broad sell-off across the entire chip industry. The result was dramatic. The PHLX Semiconductor Index plunged 10% in a single day on June 5, marking its steepest one-day decline since March 2020. Roughly $1.3 trillion in market value disappeared across the sector. But here's the interesting part. The long-term AI story did not change. The demand for computing power did not disappear. The need for advanced chips did not suddenly slow down. And the companies building the infrastructure behind artificial intelligence are still generating extraordinary amounts of revenue and cash flow. When fear creates discounts in businesses that continue to execute at a high level, investors should pay attention. Let's start with the first stock on our list. Advanced Micro Devices, ticker symbol AMD. Before we talk about numbers, let's talk about why AMD matters. Most investors think of AMD as simply another semiconductor company competing in the chip market. That description completely understates what this business has become. AMD sits at the center of multiple technology megatrends. The company supplies processors for data centers, cloud infrastructure, artificial intelligence workloads, high-performance computing, gaming, and enterprise systems. As AI adoption expands across industries, the amount of computing power required continues to grow exponentially. Every major technology company is racing to build more AI infrastructure. Every data center operator wants more performance. Every cloud provider needs additional capacity. AMD benefits directly from all of those trends. What makes the company especially interesting is that it has spent years building products capable of competing at the highest levels of the AI accelerator market. For investors, this creates a powerful opportunity. AMD is no longer just participating in the AI boom. It is becoming one of the companies helping define it. And the latest financial results show exactly why investors remain excited. During the first quarter of 2026, AMD generated revenue of $10.253 billion. That represented growth of 38% compared to the same period a year earlier. For a company already producing more than $10 billion in quarterly revenue, that level of growth is remarkable. Even more impressive was profitability. Non-GAAP earnings per share came in at $1.37, beating analyst expectations of $1.29. But the real story was inside the company's data center segment. Data center revenue reached $5.775 billion, increasing 57% year over year. Think about that for a moment. Nearly $6 billion in quarterly revenue from a segment that continues to grow at a rate most companies can only dream about. That is where the future of AMD is increasingly being built. Data centers have become the backbone of artificial intelligence. Every AI model requires massive computing resources. Every new application demands more processing power. Every enterprise deployment creates additional demand. AMD is positioning itself directly in the middle of that spending wave. The company's free cash flow tells a similarly compelling story. Free cash flow surged 253% year over year to $2.566 billion. Revenue growth is important. Earnings growth is important. But free cash flow often tells investors whether a business is truly strengthening underneath the surface. A company that can rapidly expand cash generation gains flexibility. It can invest more aggressively, develop better products, strengthen its balance sheet, and create long-term shareholder value. AMD appears to be doing all of those things, and management believes growth is accelerating. For the second quarter of 2026, AMD guided for approximately $11.2 billion in revenue. That would represent roughly 46% year-over-year growth. The company also expects gross margins around 56%, demonstrating that growth is not coming at the expense of profitability. Perhaps the most exciting development involves AMD's AI product roadmap. CEO Lisa Su recently highlighted growing customer engagement surrounding the company's MI450 series and Helios platforms. More importantly, customer forecasts are reportedly exceeding management's initial expectations. That is exactly the type of statement long-term investors want to hear. Strong current demand is good. Future demand that exceeds expectations is even better. But the most significant announcement may be the company's agreement to deploy up to 6 gigawatts of AMD Instinct GPUs with Meta. The deal includes an initial 1 gigawatt custom MI450 deployment and helps reinforce a multi-year growth thesis for the business. Large-scale infrastructure projects like this are important because they create visibility. Investors are not simply betting on future possibilities, they are seeing real-world commitments involving enormous computing resources, and those commitments could generate substantial revenue opportunities for years. Now let's discuss valuation and risk. No investment opportunity is perfect. AMD certainly has risks investors need to understand. The biggest concern is valuation. The stock trades at a price-to-earnings ratio near 179, while the forward implied price-to-earnings ratio sits around 99. Those numbers are difficult to ignore. Even exceptional companies can become vulnerable when expectations rise too high. AMD must continue delivering strong growth to justify those valuations. Another important risk involves export controls. Government restrictions affecting advanced semiconductor technologies remain an ongoing uncertainty for the industry. Changes in policy could impact revenue opportunities in certain markets. Investors should also pay attention to hyperscaler spending patterns. Many of AMD's largest opportunities depend on continued investment from major cloud and data center operators. If those companies decide to slow infrastructure spending, growth could temporarily moderate. But here's what makes AMD interesting despite those risks. The market often rewards companies that combine technological relevance, accelerating financial performance, and expanding strategic opportunities. AMD currently checks all three boxes. The company is participating in one of the most important technology transformations of our lifetime. Its financial performance remains exceptionally strong. Its AI roadmap continues to gain traction, and even after a massive year-to-date run, the stock has pulled back from recent highs as broader semiconductor weakness created new uncertainty. Sometimes the best opportunities emerge when great businesses experience temporary pressure. That doesn't guarantee success, but it often creates conditions worth studying very closely. For investors looking at the future of artificial intelligence infrastructure, AMD remains one of the most important companies to watch. And as we'll see next, the second stock on this list may have experienced an even more dramatic sell-off, despite producing some of the strongest financial results in the entire semiconductor industry. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second stock on our list. Broadcom, ticker symbol AVGO. If AMD represents one side of the AI infrastructure story, Broadcom represents another equally important piece of the puzzle. The reason Broadcom deserves serious attention is because the company occupies a unique position inside the technology ecosystem. Many investors focus exclusively on the companies building AI models or manufacturing graphics processors. What often gets overlooked is the massive networking and connectivity infrastructure required to make those AI systems function efficiently at scale. AI data centers are not simply collections of powerful chips. They are highly complex networks where enormous amounts of data must move between processors, storage systems, memory, and cloud infrastructure with incredible speed and reliability. That is where Broadcom comes in. The company supplies critical technologies that help power the movement of data throughout modern computing infrastructure. As AI workloads become larger and more demanding, the importance of networking and custom silicon solutions continues to increase. In many ways, AI cannot scale efficiently without the type of technologies Broadcom provides. That makes the company one of the most important enablers of the AI revolution. And despite its importance, Broadcom recently experienced one of the sharpest pullbacks among major semiconductor stocks. As of June 10th, shares were trading around $372.10. That represented a staggering decline from $479.23 just 1 week earlier. The stock also fell approximately 13% during the previous month and sat below its recent highs following a post-earnings reset that shocked many investors. For some market participants, that drop was enough to trigger panic. For long-term investors, it may be creating opportunity. To understand why the stock sold off so aggressively, we need to look at what happened. The catalyst behind the broader semiconductor decline was Broadcom's latest AI revenue guidance. Management projected approximately $16 billion in AI semiconductor revenue for the upcoming quarter. At first glance, that sounds fantastic. $16 billion in AI revenue is an extraordinary number by any reasonable standard. The problem was that Wall Street had become even more optimistic. Some analysts were expecting figures closer to $17.2 billion. When expectations become extremely elevated, Even strong guidance can disappoint investors. The market reacted swiftly. The result was a wave of selling that spread far beyond Broadcom itself and helped trigger the broader semiconductor correction. But here's where things get interesting. The actual business performance remains incredibly strong. During fiscal second quarter 2026, Broadcom generated revenue of $22.187 billion. That represented year-over-year growth of 48%. Think about how impressive that number really is. Broadcom is not a small startup benefiting from easy comparisons. This is already a massive enterprise generating more than $20 billion in quarterly revenue. Growing nearly 50% at that scale is remarkable. The earnings picture was equally impressive. Non-GAAP earnings per share came in at $2.44. More importantly, that quarter marked Broadcom's 8th consecutive earnings beat. Consistency matters. One strong quarter can happen by chance. 8 consecutive earnings beats suggest management understands its business exceptionally well and continues executing at a high level. The most impressive number may have been AI semiconductor revenue. Broadcom generated $10.80 billion in AI semiconductor revenue during the quarter. That represented a staggering 143% increase compared to the previous year. Read that again. 143% growth. For a business already operating at massive scale, that level of expansion is extraordinary. It tells us something important. Despite concerns about valuation, competition, and market sentiment, AI infrastructure spending remains extremely robust. Companies are still investing aggressively. Cloud providers are still expanding. Data center operators are still building. And Broadcom remains one of the key beneficiaries. Another figure that should grab investor attention is free cash flow. Broadcom produced $10.262 billion in free cash flow during the quarter. That represented approximately 46% of total revenue. Very few companies in the world generate cash at that level. Strong free cash flow gives management flexibility. It supports acquisitions. It strengthens the balance sheet. It creates shareholder value. And it provides a cushion during periods of market uncertainty. One reason investors continue to follow Broadcom closely is CEO Hock Tan's track record. Throughout multiple technology cycles, Broadcom has demonstrated an ability to identify important growth opportunities and execute effectively. His outlook for AI demand remains particularly noteworthy. Management expects semiconductor revenue from AI to grow more than 200% year-over-year to approximately $16 billion during the third quarter. Take a moment to appreciate what that means. The market punished Broadcom because the AI guidance came in below elevated expectations. Yet management is still forecasting AI growth above 200%. That disconnect between investor expectations and underlying business performance is exactly what creates opportunities in the market. Sometimes a stock falls because the business weakens. Other times a stock falls because expectations simply became unrealistic. Understanding the difference is critical. Broadcom's broader guidance was equally impressive. Management projected approximately $29.4 billion in consolidated third-quarter revenue. That implies roughly 84% year-over-year growth. Those are not numbers associated with a struggling business. Those are numbers associated with a company benefiting from powerful secular growth trends. Wall Street appears to recognize that reality. Analyst targets average roughly $522.06 per share. Even more notable, bullish sentiment remains exceptionally high. The vast majority of analysts covering the stock continue to maintain positive views despite recent volatility. Historical data also provides an interesting perspective. According to market research highlighted after the sell-off, single-session declines greater than 15% have occurred only 3 times in Broadcom's history. Each of those instances was followed by strong returns over the next 6 to 12 months. Of course, history does not guarantee future performance. Every market environment is different, but it does suggest that dramatic sell-offs in high-quality businesses sometimes create attractive entry points for patient investors. Now let's talk about the risks. The most obvious risk is the one investors recently reacted to. Broadcom's AI guidance failed to satisfy extremely optimistic expectations. If growth slows further or future guidance disappoints again, additional volatility is possible. Investors also need to monitor margins. Management indicated a softer gross margin outlook, which contributed to concerns following earnings. While the company remains highly profitable, margin compression can impact investor sentiment. Another important consideration involves customer concentration. A significant portion of Broadcom's AI opportunity comes from large hyperscale customers. When a handful of customers represent major revenue sources, spending decisions from those customers become increasingly important. If hyperscaler capital expenditures slow unexpectedly, growth could moderate. There is also leverage associated with Broadcom's VMware acquisition strategy. While the company continues generating enormous cash flow, investors should always monitor debt levels and integration execution following major transactions. Still, when evaluating the broader picture, the investment case remains compelling. Broadcom sits at the intersection of several powerful trends: artificial intelligence, cloud computing, data center expansion, networking infrastructure, custom silicon development. These are not short-term themes. These are multi-year and potentially multi-decade growth drivers. And despite all of that, investors recently had the opportunity to buy shares after one of the sharpest declines in company history. Markets often create opportunities when expectations become disconnected from reality. The reality is that Broadcom continues producing tremendous revenue growth. The reality is that AI demand remains exceptionally strong. And the reality is that the company's long-term role in AI infrastructure appears more important than ever. The question investors need to answer is simple. Did the business suddenly become worse, or did the market simply become too pessimistic? For those willing to look beyond short-term volatility, Broadcom may be one of the most interesting semiconductor opportunities available today. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now it's time for the final stock on our list: NVIDIA, ticker symbol NVDA. And for many investors, this is the company that defines the entire artificial intelligence investment story. When most people think about AI infrastructure, NVIDIA is usually the first company that comes to mind. But what makes NVIDIA so remarkable is not simply its leadership position, it's the scale of that leadership. The company has become the central supplier of the computing power required to train and deploy advanced artificial intelligence systems. From large language models to enterprise AI applications, NVIDIA hardware has become deeply embedded in the foundation of the modern AI economy. The result is one of the most dominant growth stories the market has ever witnessed. Yet despite all of that success, NVIDIA has not been immune to the recent semiconductor sell-off. As of June 10th, shares traded around $200.42. The stock sat approximately 26% below its 52-week high of $236.26. Over the previous month, shares declined about 9%. Over the previous week, shares fell roughly 7%. For some investors, that pullback may look concerning. For others, it may look like the first meaningful opportunity to buy a world-class business at a discount in quite some time. To understand why investors remain so excited about NVIDIA, we need to look beyond the stock chart and focus on the business itself. The most important thing to understand is that NVIDIA is not merely selling chips. The company is helping build the infrastructure layer of artificial intelligence. Think about the scale of what is happening globally. Technology companies are investing hundreds of billions of dollars into AI infrastructure. Governments are investing. Enterprises are investing. Cloud providers are investing. Research institutions are investing. Virtually every major organization that wants to compete in the AI era requires massive computational resources, and NVIDIA remains one of the primary suppliers. This creates an extraordinary economic engine. As long as AI adoption continues expanding, demand for high-performance computing infrastructure should remain significant. That reality becomes very clear when examining the company's latest financial results. In the first quarter of fiscal year 2027, NVIDIA generated revenue of $81.615 billion. Yes, billion. In a single quarter. That represented growth of approximately 85% compared to the same period a year earlier. Most companies would celebrate reaching $1 billion in quarterly revenue. NVIDIA generated more than $81 billion, and it is still growing at a pace that most smaller businesses could only dream about. The earnings performance was equally impressive. Non-GAAP earnings per share came in at $1.87. That exceeded analyst expectations of approximately $1.77,388. Strong revenue growth is impressive, strong earnings growth is important. But what truly demonstrates the strength of NVIDIA's position is where that revenue is coming from. Data center revenue reached $75.246 billion during the quarter. That represented a remarkable 92% increase year over year. In other words, the overwhelming majority of NVIDIA's revenue is now tied directly to one of the most powerful technological shifts in modern history: artificial intelligence. Even more impressive was the company's networking segment. Networking revenue increased 199% year over year. That figure highlights an important reality many investors overlook. AI infrastructure requires far more than processors. Data must move rapidly between systems, storage, servers, and clusters. The networking layer becomes increasingly valuable as AI deployments scale. NVIDIA is benefiting from both sides of that equation. The company is not simply selling computing power, it is helping create entire AI ecosystems. Then there is the cash generation. Free cash flow reached an astonishing $48.554 billion during the quarter. That number is almost difficult to comprehend. Many public companies do not generate that much revenue in an entire year. NVIDIA produced nearly that amount in free cash flow alone during a single quarter. Why does that matter? Because free cash flow creates options. It allows companies to invest aggressively. It allows them to innovate. It allows them to withstand economic uncertainty. And it gives management flexibility to pursue opportunities that competitors may not be able to match. The guidance was equally impressive. Management projected approximately $91 billion in second quarter revenue. Just pause and think about that. $91 billion in quarterly revenue. That forecast also includes an expected non-GAAP gross margin of approximately 75%. Very few companies can combine massive scale, rapid growth, and extraordinary profitability simultaneously. NVIDIA is currently doing all three. One of the most powerful insights from management came directly from CEO Jensen Huang. He described the current environment as the largest infrastructure expansion in human history. That may sound dramatic at first, but when you consider the hundreds of billions of dollars flowing into AI infrastructure worldwide, the statement begins to feel much less like hyperbole and much more like reality. Data centers are being expanded, AI factories are being built, cloud capacity is growing, the race to secure computing power is accelerating, and NVIDIA remains one of the primary beneficiaries. Wall Street appears to agree. Analyst sentiment remains overwhelmingly bullish. The company currently carries 48 buy ratings and 10 strong buy ratings compared with only a single sell rating. Consensus analyst targets sit around $298.42 per share. That suggests many professionals still see substantial upside despite NVIDIA's enormous run over recent years. Of course, no investment is risk-free, and investors should understand the challenges facing NVIDIA. One of the biggest concerns involves export restrictions. Management's second quarter guidance explicitly assumes zero data center compute revenue from China. That is significant. China has historically represented an important market for advanced computing technologies. Changes in export policy could materially impact future results, either positively or negatively. Investors must continue monitoring regulatory developments closely. Management also warned about a substantial increase in cash taxes during the second quarter. While that does not necessarily alter the long-term investment thesis, it remains an important factor affecting cash flow and profitability. Another consideration is expectations. NVIDIA has become one of the most closely followed companies in the world. When expectations reach extremely high levels, even strong results can occasionally disappoint investors. We've already seen how quickly sentiment can shift across the semiconductor sector. But despite those risks, the broader investment case remains difficult to ignore. The AI revolution is still in its early stages. Many businesses are only beginning to integrate AI into their operations. Governments continue investing, enterprises continue investing, cloud providers continue investing, and demand for advanced computing infrastructure continues rising. NVIDIA sits at the center of that trend. Now, let's step back and look at the bigger picture. The recent semiconductor sell-off created fear across the market. Broadcom's AI revenue guidance came in below elevated expectations. Investors reacted aggressively. The PHLX Semiconductor Index experienced its deepest one-day decline since March 2020. Roughly $1.3 trillion in market value disappeared, yet something important happened during that sell-off. The long-term AI thesis remained intact. NVIDIA continues guiding toward approximately $91 billion in quarterly revenue. AMD continues projecting roughly 46% year-over-year growth. Broadcom continues forecasting approximately 84% year-over-year consolidated growth. Those are not numbers associated with a collapsing industry. Those are numbers associated with an industry experiencing extraordinary expansion. The key question moving forward will be whether hyperscale customers continue investing aggressively in AI infrastructure and whether export policies evolve during the remainder of the fiscal year. Those factors could influence short-term performance. But long-term investors are often rewarded for focusing on business fundamentals rather than short-term market emotions. And that's exactly why these three companies deserve attention right now. Each operates in a critical segment of the AI ecosystem. Each benefits from powerful secular growth trends. And each is currently trading below recent highs following the June semiconductor pullback. That combination makes them worthy of serious research. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here, Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd like to hear from you. Which company do you believe has the strongest long-term competitive advantage? AMD with its growing AI accelerator business, Broadcom with its critical networking and custom silicon infrastructure, or NVIDIA with its dominant position in AI computing? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.